BlackRock says that they are seeing a once-in-a-generation opportunity, and it starts with the higher interest rates that we've been seeing. The higher interest rates are enticing more and more investors to move their money into money market funds, and this is happening faster than we've ever seen before. Well, what's interesting is I was reviewing BlackRock's latest earnings reports, and one of the things that they talked about was this huge growth in money market balances, and they said, quote, "We're calling this a once-in-a-generation opportunity." That was when I started digging a little bit deeper, and I learned that BlackRock even created an entire report about how this money market blow-up is creating a generational investment opportunity. So I've already spent the time reading through and analyzing the report. I'm going to break it down for you here, but if you want to read the report for yourself, I'll also link it for you down in the description. But to really lay the foundation, you have to start by understanding what is a money market, because there are money market accounts, like what your banks offer, and then there are money market funds. If you go to your bank to open up an account, they're going to give you the option to open up a checking account, a savings account, and maybe even a money market account, which is kind of like a glorified bank account where now you have the option to get higher interest rates than a savings account, but you also have the ability to write some checks out of your money market account, plus it's FDIC insured. But these money market accounts is not what BlackRock is referring to. They're talking about money market funds. Money market funds aren't offered by banks when you go to open up a bank account. They are a type of mutual fund that's offered by mutual fund companies like Fidelity and Vanguard, and these money market funds are not investing in stocks. Rather, they are investing in debt, like loaning money to the United States government. Now, the difference here is that these money market funds are not FDIC insured, but they give investors the ability to earn some interest on their savings, because now instead of keeping your money in the bank in a savings account, you can put your money into this money market fund and get some interest and hopefully keep your money safe. That's the key. And what BlackRock has been pointing out is that over the last number of months, we've been seeing a massive flood of money into these money market funds as investors are looking for a safer way to finally get some interest on their savings. Now that we've established that, let's jump into the BlackRock report. Now, I also want to give you a quick reminder that on August 15th, it is the 52nd anniversary of the dollar being taken off of the gold standard, and I am going to be hosting my first ever investor summit. I've never hosted one of these before, but I'm going to be hosting this investor summit where, number one, I'm going to talk about the changes that we've seen in our economy, how we're entering a new economy right now, and then even more importantly, how you can capitalize on the new opportunities in our economy today. This investor summit is completely free and it's virtual. That way you can watch it from anywhere in the world. So if you want to join, there's a limited number of seats because our software only can host a certain number of people. So if you want to join, while you still can, I got the link to how you can sign up for my investor summit in the description below. Now, if we jump into BlackRock's report, the report starts by saying the new market regime has unlocked investment opportunities in fixed income and credit not seen in a decade. What does that mean? People have the ability to finally get a return on their cash. But the question is, why has this been happening? In BlackRock's words, the Fed's hiking activity has raised all boats. What that means is that over the last 18 or so months, when the Federal Reserve Bank has now started raising interest rates, these higher interest rates mean two things. Number one, when you go to borrow money to get a mortgage, it's going to cost you more money because the banks have to pay higher interest rates to borrow money themselves. See, the Federal Reserve Bank doesn't set mortgage rates. They set the federal funds rate. You can think of this like the wholesale price that banks have to pay to borrow money at. And now because banks have to pay more money to borrow money, they have to charge you higher rates to borrow money from the bank. So you borrow money at the retail rate, banks borrow money at the wholesale rate. That's happening on the consumer side. But it also creates an effect when you save money. Like if you go and save your money in the bank, banks now have the ability to pay you higher interest rates because interest rates have gone up. Banks are paying or getting higher interest rates, higher margins when they lend money out. And so they pay you a little bit higher interest rates when you save your money in the bank. And this is where now investors who have a lot of cash can look for ways to get a yield or a return or some interest on their savings. Now, this could be you putting your money into a CD. This could be putting your money into a high-interest savings account. Or this could be you putting your money into something like a money market fund, which has the ability for somebody to put in more money, and you can also get potentially higher interest rates. And hopefully, as long as the economy is good, your money will be safe as well. What BlackRock says is that now investors can reach their investment return target without having to reach aggressively into higher risk products. Right now, in today's economy, if you're sitting on cash, there are ways for you to get 4 to 5% in interest on your cash, whether it's a high interest savings account or whether it's a money market fund. And before, if you wanted to get 4 to 5% of a return on your money, the only way you could do that was not by putting your money in the bank. It was not by putting your money into a CD. You would have to put your money into the stock market or the real estate market or into a business idea, something that was riskier than just keeping your money in cash. Because when you keep your money in a savings account, that's less risk and generally less reward. But now because of the higher interest rates, you can get higher returns in a high interest savings account or a money market fund. Now, the reason why BlackRock says this is important is because bonds should once again offer hedge and diversifying potential in portfolios. So now we know that interest rates are higher because of the Federal Reserve Bank. People can get a return on their cash, but what does the growing amount of money in money market funds have to do with BlackRock, and what are they actually doing about it? Well, let me actually just read you what BlackRock said from their earnings call. The trillions currently in money market funds are, quote, ready when people feel their rates have peaked to flood the fixed income market, and we need to position ourselves to capture that. So the Federal Reserve Bank has been raising interest rates to fight off inflation. This higher interest rates have given investors the ability to finally get a return on their cash by putting their money into places like money market funds. But this is where BlackRock is saying that we could be reaching a peak in higher interest rates in the future because inflation has been falling. So if the Federal Reserve Bank stops raising interest rates, that means the interest rates that you get on your high interest savings account or your money market funds could be peaking as well. And when investors take a look at their money market funds peaking in interest rates, because over the last 6 to 12 months, the interest rate that you've been getting on your high interest savings account, on your money market funds have been rising because the Federal Reserve Bank has been raising interest rates. Once that interest rate peaks, or when investors are confident that the rate has peaked or is close to peaking, then they might start looking for alternatives. And right now, we have more money than ever sitting in money market funds, trillions and trillions of dollars. And that's where BlackRock is saying investors are going to want to pull money out of their money market funds and deploy it somewhere else. Maybe they'll put it into stocks, maybe they'll put it into real estate, or maybe they'll put it into fixed income assets. That's what BlackRock is predicting because investors have become so accustomed to this consistent return. Now, to make sure we're on the same page, what are fixed income assets? These are generally things like bonds, where you're investing your money into a loan, you're loaning your money out, and then you get a return for lending your money out. And this is where, on BlackRock's position, one of the things that they're doing is they're positioning their bond offerings to capitalize on when investors want to move money out of their money market accounts. But what they're saying is that there's all this money essentially sitting on the sidelines. And the reason why it's sitting on the sidelines is because investors are saying, you know what, I'm looking at the investment opportunities out there. I'm looking in the stock market and everything's overvalued. I'm looking into the real estate market, everything's overvalued. And investors have stockpiled all this cash, trillions of dollars. And so now they're just looking for any yield, any return. And where are they getting this return right now? Well, it's these money market funds. It's a place where they can get some sort of interest on their money. The principal on the money is not really doing anything, but they're getting some interest on their money, which is the value now for the investor. Well, when the returns on these money market funds start to peak out because now the Federal Reserve Bank is no longer raising interest rates, that's when investors are going to say, okay, now what are our options? Because the money market funds are kind of tapped out. We don't want to just have this money growing at a certain rate and not capitalize on new potential opportunities. This is where BlackRock is saying, well, new opportunities are going to arise with things like lending money. Because now with the higher interest rates, investors will have the ability to get higher returns by lending their money. And potentially, you could see a flood of money moving into places like the stock market, assuming that investors feel they can get a good return in the market. But the interesting thing here is on an economic level, there's a lot of money still sitting on the sidelines. And anytime you start to see an economic downturn, that money on the sidelines has already dissipated. There was a lot of money created in 2020 and 2021. That money is still there. It's in different places, but that money still is there, and some of that money needs to be dissipated. So that could create booms in different parts of the markets. And this is what BlackRock is talking about. With all this money sitting in money market funds, this money market fund has blown up, and now when interest rates stop rising, that's when investors might start pulling their money out of money market funds. And because of the amount of money in market funds right now, that could be a lot of money that comes out. So there's three things that BlackRock talks about that they're doing. Number one is that they're optimizing liquidity, meaning they want to have easy access to their money. That means working on investing their money into things like short-term bonds as opposed to tying up their money for 30 years. The second thing is rethinking core allocations. That means one of the things that they're looking for is the lowest risk or potentially risk-free, what they call risk-free investment options. And the third thing is considering non-benchmark exposures as diversifiers. That means for them, diversifying their money across different sectors and different assets. So now, what does this mean for you? Well, number one, if you have cash sitting on the sideline, get some sort of return on that money. Don't just keep that in an account that's getting you 0.01%. There's a lot of ways to do that. You can look at high interest savings accounts, which are FDIC insured. You could potentially look at other types of accounts that are giving you interest. But this is where BlackRock is saying that money market funds have grown significantly. They are not FDIC insured, but they believe that some of this money is going to start leaving money market funds once the Fed stops raising interest rates. If that were to happen, we could see a big movement of capital, a big movement of money, because we're talking about trillions of dollars that is sitting in money market funds that could go into other asset classes. That could be bonds, that could be stocks, that could be real estate. Well, anytime money moves into other asset classes, the value of that asset class goes up. So this is where BlackRock is predicting that a big chunk of this money is going to go into bonds. And so they're positioning themselves through their own types of short-term bonds. That way they can capitalize on that move. Now, you do not want to blindly follow or copy or listen to what anybody does, especially a random guy on YouTube. But my goal with this is to help you to understand what's happening from different positions and different perspectives. That way you can be a more educated investor, understand what different people's perceptions are. That way you can make the best educated decisions for yourself. That means number one, you need to work on your own financial education. Number two, you need to work on being prepared for yourself, getting your money right. And then number three, staying up to date on what's happening. That's one of the reasons why I created Market Briefs, my free financial newsletter. That way you can stay up to date on what's happening when it's happening. That way now you can make the best decisions for you, your family, and your community. Americans are spending more money than ever before, even if they don't have the money to spend. And this is a sign of how strong our economy is. At least that's according to economists who say that not even a recession can hurt our spending here in America. And what this article says is that there are three main factors which are contributing to the growth